Today's market call is presented by Fidelity Investments and their all-new advanced trading platform, Fidelity Trader Plus. With Fidelity Trader Plus, you can customize your preferred tools and charts and tap into crucial data across all your devices. So I can save an order on my desktop at home, get a mobile alert here at the studio, and complete the trade in the Fidelity app without starting over. Try it for yourself at fidelity.com/Trader Plus. Great, there's a Monday this year. That's today, 11 a.m. on the East Coast. By the way, I logged in an hour ago for some reason because I had my head somewhere where it probably shouldn't be. I don't know what to tell you, but I'm Swizz. That's Dan Nathan. We got a big show today. We actually have a guest on the back end of this show, Dan. You got to stick around.
Yeah, we have a great guest, and it's somebody that I've known for a while, I've done work with for a while. This would be Heather Knight. She's a vice president of national brokerage coach at Fidelity. We do a little rates guy in front of the Fed meeting. We do a little, one of the names that's reporting earnings this week, we're going to hit a bunch of them, but that really caught our eye and we want to focus on, that would be Adobe. We talk about some different option strategies, so stick around for our conversation with Heather Knight. Guy, this is one of those days. You know, we've been hearing about the broadening out, the dispersion, right, between what's gone on in the Mag 7 or the Fateful 8, whatever you like to call them, and the rest of the market here. Now, that's a little smirk. I get it, buddy. But today, like, retail's getting hit. Energy's getting hit. Home builders are getting hit. A couple other things in the market that staples. Pull up this Proctor chart for a second.
Yeah, like, we talked about that last week.
We did, but look at this thing falling out of bed. Like, look at that. And if you want to, yeah, there you go. I mean, look at that downtrend. I mean, this is Procter and Gamble, guy. I thought we were seeing this trade down. I thought we saw consumers that are really focusing on the things that they need. And I'm not trying to shed light, you know, I'm not being sarcastic.
No, I know you're not.
To me, this is really interesting, especially on a day. Look at Dollar General. You know, look at Costco. Even Walmart's down, but it's off from an all-time high. But my point is, well, Dollar General had that breakout. That's the worst example. I'm sorry there, people.
No, it's okay.
Costco, which reports
Procter & Gamble. Listen, Procter & Gamble is a great example. So let's throw that chart up and go longer term, because you can see this sort of 140 level. I mean, this better be support, because if you draw a horizontal line, there you go. I mean, you can see basically where support should be in the form of this chart. Prior resistance, prior support comes right in around, you know, let's call it 138.5, 139. What's the problem with Procter & Gamble? Well, for a long time, it was valuation, but we also were environment for a long time. Nobody cared. But now valuation is a concern, and their business, I don't want to say is deteriorating, but obviously they're seeing some fraying of the business, and it's manifesting itself in margins. And, you know, again, the entire market is not Procter & Gamble. Dan's not saying that. I'm not saying that. But when you look at a company this important, it basically touches almost every aspect of our consuming lives in some way, shape, or form. And you see how poorly it's traded over the last year or so. I mean, this is a 52-week low on a broader market that's basically at an all-time high. I think that's telling you something.
Yeah, just worth noting. I mean, this is one of the names you think would be acting decently as far as the macro is concerned, not as far as the market, because we get it. This is a defensive sort of name. Guy, before we get to the Fed meeting, I want to rip through a few things here. Tesla downgraded at Morgan Stanley. So Adam Jonas used to be the long-term bull Tesla analyst at Morgan Stanley. Great guy, really smart guy. He's taken a new role at Morgan Stanley. He was telling me about it this summer. We were at a conference together, and it's like a futurist sort of job. He's thinking about all these different sort of trends that's going on. And again, all the power to them for kind of focusing on this sort of stuff. But what's interesting to me about this downgrade, guy, to a hold, is that Morgan Stanley, if you think about all this capital markets activity, you think of all the sort of businesses that Elon Musk is involved in, whether it's SpaceX, whether it's, some of these other businesses, XAI and the like, you'd think that they are in the catbird seat to do a lot of his banking. When he bought Twitter, they did like a big chunk of the debt that he raised. So I just find it interesting. Obviously, equity research and banking are supposed to be separated, but don't think for a second when Elon and his team see that the equity research department at Morgan Stanley that he's done a bunch of banking with, you know what I mean, is not going to play into the way they think about this sort of stuff.
Well, at least listen, first of all, yes, because that's just human nature. But through this lens, the system is apparently working, and that line of demarcation between banking and research is still there. Now, I look at this, and you can draw an uptrend line from the April lows. You can connect it, Amanda, with the August lows, and you can see that uptrend is in place, and you can see where support theoretically should be. I mean, there's your trend line. So call it time decay, maybe 410 or something like that, if you want to fudge the line down a little bit. That's your uptrend. There's where your support's going to be. Obviously, the longer term support comes in the form of a flattening 200-day moving average at 345, let's call it. But that's where we are. So the uptrend hasn't been broken. I think if you look at this, you could say, well, you know what, guy, we made a couple runs at this sort of 455, 460 level and failed. So that support line is going to be tested. Yeah, I think that's fine. And I think you're having a lot of people struggle with, what is Tesla? Because if you're just buying Tesla because of his pay package and because of all the other ancillary things, then $50 in terms of the stock makes no difference, because there are a lot of people that think this is going to be a $7 to $10 trillion company. I am not one of those people, by the way, but you have to figure out what bucket you're in.
Yeah, I would just highlight it because I think the way you just framed it, maybe this is working well the way it's meant to be working, right? And this is going back to all the comparisons between now and the .com. I mean, one of the big issues that came out of that, as far as Reg FD was concerned, is like the separation between banking and equity research. What we found were that a lot of these equity research groups within an investment bank had really rosy outlooks and strong buy ratings, despite the fact they didn't believe that was the case, but they wanted to do more banking business. Guy, another one, Dan Ives, my friend from Wedbush, I'll just say our friend of the pod, is out with a bullish note on Apple today. He thinks they're finally going to get their act together as it relates to AI in the new year. So we think that's going to be a big theme. There has been a lot of turnover as it relates to management. And there's been this story out there that they're working pretty aggressively for succession for Tim Cook. You can draw a very simple uptrend
from the August low. Yep.
Yeah, right there.
So draw that, and we're right on it now.
Yeah, give me the 411. This thing looks a lot like.
Real quick, and then if you want to draw the April low and connect the August low, where the theoretical huge support should be, you're looking at 0.1, 0.2, and then the third point will come in, I don't know, somewhere around 240. So as we used to call that, Dan, that's a hungry alligator, I think, if I'm not mistaken.
Yeah, that is. I just wanted to bring that up because, between that and Google, pull up Google for a second, obviously Google has just stolen the thunder on both the model front, but now also obviously on the chip front. So this is a two-pronged attack here. You just see what's going on there. You see how far above its 200-day moving average. What is that, 200 down there, Guy? Am I looking at that?
Yeah, so and this does not happen. I mean, obviously we've decoupled, and we talked about this. It started in July. It started really happening in August. And then you had that earnings release, I think, in early September that everybody sort of got jazzed about, and we're off to the races. And I think this is another name we've done a decent job. We sort of did back of the envelope math, how this could be a $340 to $350 stock, just giving them the valuation that some of these other companies enjoy. And that's probably fair value. I don't think it got that high, but you can see we're sort of leveling off here. Now you have to say, play a little stock market. Is this thing going to continue this upward trajectory to do a back and fill? And the back and fill comes in the form of that trend line. You could draw another trend line if you want from sort of the June low. Yeah. And that's probably a little bit cleaner. I don't know at what point, if and when, we're going to get back to the sort of 200-day moving average, but that's obviously your ultimate support. And that's sort of 75, your first level of support.
Yeah, I don't disagree. A little check back would be pretty healthy too, if you think about it. And then really quickly on the chip front, Marvell last week reported good quarter, good guide. This one's down 10% today. And there's reports that Amazon might be pulling back from some of the custom chips that they're making with Marvell. And therefore, Amazon's moving forward with some of their own chips. They have chips. They have this Trainium chip. But everyone, the main theme here, Guy, as it relates to chips, and one of the reasons, let's pull up NVIDIA for a second here. Everybody, and you've been saying this, what do you say in perpetuity was not going to happen for NVIDIA?
Margins. They're 75% margins. They're not going to enjoy them in perpetuity. And I think you would agree with that. I certainly agree with it because I say it like seemingly every day.
Well, I didn't mean it like
No,
that.
no,
But
no, no, no. I know that. I know
I know.
this.
My point is that you've been very clear about this. I think you and I have been clear that the idea that NVIDIA, because of, supply demand sort of, dynamics, would be able to have this pricing power. Every point of, percentage point of margin that they have is against their customers who've been squeezed for 3 years now. And don't think for a second that if you're Google or you're Amazon or you're one of these custom ASICs companies or you're AMD, you're not thinking about how to get some of that margin. Right?
100%.
Now that being said, though, you're going to have to compete on price, so it's going to take a while to actually see your margins expand.
Yeah, and then other people will explain to me, well, you're missing it, guy. It's not just the chips themselves. They created this ecosystem, basically the software, and all these different things that, listen, I don't entirely understand, but basically what they're telling me is they've created such a wide moat and deep moat that even if competition comes, it's going to take some time. And maybe there's some truth to that. I will tell you, though, and this is just my view, in today's world, I think things happen a lot faster. And the old Amazon line, your margins are my opportunity. And don't think for a second, as Dan just said, that there are other companies out there not trying to figure out how to sort of tap into this same marketplace. And I think it's just an inevitability that it'll happen. And it's not an indictment on NVIDIA at all. It's just sort of the natural process of the business cycle.
Yeah, I mean, the other point is China, right? So we know that Jensen, they're lobbying the administration really hard to get rid of some of these, export bans. But if that never comes to fruition and the Chinese continue to innovate on their own side using Huawei chips and clusters and the like, and they're able to chain their make no mistake about it. I mean, they're using NVIDIA GPUs. They're training a bunch of these models in Singapore and places that they've avoided, some of these export bans. So that is what it is. One last thing before we get to, let's do this. Let's do some macro stuff. So David Rosenberg of Rosenberg Research.
We just call him Rosie.
We just call him Rosie. One of my first reads every morning. I thought this was really interesting. I know Doug Cass was talking about the equity risk premium last week, how it's collapsed. It's at lows we haven't seen in a very long time. And Rosie highlights this, and this is a great point. I was reading the journal early this morning, and I was scrolling through on my phone, and I see these two articles, and it hit me the same way it hit Rosie's. There's two articles in the journal. American consumers sour on the economy's trajectory. And then the other one is investors feel good about the stock market. Now, what you and I talk about a lot is that the stock market is owned by a certain group of consumers, and then those that are feeling trepidation about the economy, whether it's wage growth, whether it's the job security, whether the whole host of inflation, that sort of thing. I mean, it's an interesting split screen, and Amanda put together a little visual here of this thoughts, because these sorts of disconnects usually find themselves, I think, meeting at some point. I don't mean meeting in the middle, but this could be one of the sides that's going to go meet up with the other side, and usually it's either up or down. It's not.
Don't tell. It's amazing that people don't learn this lesson. And when I say people, I mean generally politicians, but other people as well. Don't try to tell people how they should be feeling or what they should be feeling, because it's not going to work. If people feel shitty about things, you telling them that they're wrong doesn't help. And that happened under the prior administration, and to a certain extent, it's happening now. People are feeling the pinch, and it's happening in real time. And I think that's why people, cranky? Yeah, well, that's why people are cranky. Now, the disconnect between that and the stock market is obvious, and we talk about it all the time. I also mentioned this, is the labor market either continues to or starts to deteriorate, that crankiness is not going to get any better. And at some point, I think to your point, it's going to make its way into the stock market. So although not everybody owns stocks, we say that all the time, the one big gauge for consumer sentiment and how people feel about things historically has been the stock market. So if the stock market starts to show the signs of what people are actually feeling in real time, then things are going to get a little bit interesting on sort of the economic front, I think. And that's how you sort of tie all this stuff together.
Yeah, and on the consumer front, I mean, I kind of mentioned it before, but I'm looking at my screens right now. Nike down nearly 3%. On is down 4.5%. Lulu is down 4.5%. Dick's is down nearly 4.5%. I mean, from a consumer discretionary standpoint, we just talked about staples, but Interesting stuff here. And then, I see Macy's down 3.5%. In general, I mean, might we have had the surge of spending, whether it was Black Friday, Cyber Monday, that sort of thing. And a lot of the numbers year over year, they were low single digit percentage, you know what I mean, up. So it wasn't like a huge like surge, and it was also probably very heavily discounted.
Yeah, agreed. And again, the mistake, I shouldn't say that. What I feel is a mistake is people make the through line between consumer spending and the health of the consumer. And I think that's just foolish to do. And, we had a conversation last week about delinquency rates and how things across a wide scope, wide swath of different metrics, how delinquencies are on the uptick. And people will say, well, it's not at alarming levels yet. And maybe that's true, but it's the rate of change that I think people should be watching. And, again, if the job market starts to break down, and we're going to talk about the bond market in a second, and you tell me when that sort of manifests itself in the stock market, and then throw Bitcoin in the mix as well, which obviously bounced off those lows we saw, I guess, early last week or the week prior. But it's not like you've seen this robust bounce. It's not like it's off to the races bounce. So I think that's something that people should watch as well.
Yeah. All right. Let's talk yields. We know that the CME Fed Watch tool is suggesting a 90% probability of a 25 basis point cut at the Fed meeting in a couple of days. And it's doing 10-year yields are doing what you thought they would do, which is counterintuitive, right, to the notion that, we're going to get a rate cut. Now, granted, this is a Fed funds rate, and we know that the 2-year Treasury, that yield tracks much closer to Fed funds. But the 10-year has been volatile since we started cutting interest rates. When I say we, I mean the Federal Reserve. This goes back to September 2024. But the 10-year yield is now at a level, nearing that 4.2% where we broke down in September. And that was prior to that rate cut that we had. It was a 50. Well, no, that one was a quarter. The 50 that we saw was September 24. Is that correct?
Yep, that's correct.
But you see what happened.
Yeah. And so, and go, if Amanda wants to go longer term, we can see 50 in September of 24, 10-year yields went from 3.6 to 4.6, not in a straight line, but, in pretty short order. We obviously got the rate cut September of this year. I think yields briefly went below 4%. They subsequently rallied. They subsequently came off. And now here we are, basically, 2-month highs in terms of yields. And I think higher still. So if you got to sort of zoom back in, you can see the 200-day moving average, to the extent that anybody cares, is probably 4.25. We're through the downtrend if you want to play that game from late last year. If you really want to get funky, you could draw a trend line down from the highs that we saw in 2023, connect that top, and then see where we potentially could go. Now, that's sort of a flat line, but you could see where maybe the ultimate objective is. Probably comes in around 4.6 or so. I think we're going there, and I think we're going higher. And it's not just me that's saying that now. I think more and more people are starting to talk about the independence of the Fed. That's, I think, a bearish thing for the bond market. I think there's a lot of talk about the next Fed chair, and if he's just basically a lackey, I think that's bond negative. Obviously, global rates are starting to move to the upside. We have a huge debt problem as well. And then throw on top of that the fact that the market will always test a new Fed chair, regardless of who or she is. And in this case, the test will come with yields moving higher, I think. So stay tuned, sports fans.
Yeah. And I just want to go back to Torsten Slok in the Daily Spark. And this is interesting. So you see this, I just want to kind of highlight a few things here. So he was talking about defaults, and he was talking about, despite some really high profile ones, we're not seeing that to a larger degree. And he makes the point, we hear this all the time from strategists, that the bottom line is the U.S. economy remains incredibly resilient. But scroll down a little bit, Amanda, and I think this is probably the most important part, because he's talking about if default rates aren't going up in a meaningful fashion, right, and the economy remains resilient, he's saying, in short, a data-dependent Fed would come to the conclusion that they should not cut interest rates, when they were, that he said this was last week, so next week. And, I think about this guy, and, he's obviously a bit of a contrarian. Somebody else who's a bit of a contrarian was highlighting this on his Substack. So this would be Michael Burry. And, it's funny when we talk about Fed Chair Powell, he's highlighting this here also. But, what is his legacy going to be, right? So after this meeting, he's got 3 more. In January, they're going to announce the new Fed chair, right? I mean, does he stand pat? Does he just basically remain data dependent? Does he actually knows because he's going to hand it off? No matter what happens, he doesn't have to deal with, the idea. Like, listen, they'll blame him if something goes haywire right after May, but it'll be interesting. What do you think the stock market would do if he actually, let's just say it's a hawkish cut?
Yeah, I think that's what a lot of people are anticipating. And it's amazing that we got down to 35% probability of a rate cut this week. That was only 2 weeks ago. I don't really know where that came from. But all right, foregone conclusion. Hawkish cut, market won't like. To answer your question about his legacy, it's going to be a couple things. It's going to be the fact that he got browbeat in the early part of his tenure. That was the fall of 2018, I believe. He'd been in the seat for about 5 months. You remember the press conference, he talked about autopilot for reduction of the balance sheet or autopilot in terms of rate hiking cycle. Market didn't like that. The market sold off. The administration got on his ass, and he basically did an about face in January of 19. I think that's one. Number two, the fact that transitory was a word that he used incorrectly, obviously. And then the third is going to be that he's basically getting eviscerated by this current administration. And regardless of what happens, he's going to continue to get eviscerated in the same word I used before, in perpetuity. So it sucks for him. But as I always say, it's that Hamlet thing, uneasy lies the head that wears the crown. He's in the seat, and you got to take the shit that comes with it. I think he's done an okay job. I don't think he's done a great job. I think he's fine. I don't think it's an easy job at all. I was outraged by a number of different things, not that I'm anybody. And I think there are a lot of people that think they should stand pat here and soar because the data suggests exactly that. There are other people that say they're 1.5% behind the curve. I have no idea. I'll tell you this, though. They can do whatever they want to the front end. I'm still of the belief that 10-year yields are going higher, and that's not going to be good for the stock market.
Yeah, no doubt. All right, we talk a little bit about this with Heather Knight from Fidelity. So check out our conversation here. We also move into Adobe and their earnings this week. On the other side of this conversation, Guy and I are going to talk about some implied moves and some of the names that are reporting this week. Oracle, Guy, which is one that we found pretty interesting over the last few months or so. So we're going to hit that. And there's a couple other names. Broadcom is reporting this week also. So check out this conversation right now. Guy, myself, Heather Knight. Welcome to the Market Call.
Hey, Dan, thanks for having me. Appreciate it joining today.
Guy, as you know, Heather and I go back. It was
way back.
It was the throes of the pandemic. We were doing it all from home, trading up the options for the people. So it's really great to have her join us here. We're going to cover a couple topics. Obviously, the Fed, that will be the main event this week. And then we also have Adobe, the last really big earnings event of this year. Guy, what are we thinking here, the Fed? I just mentioned this. The S&P 500 is implying about a 1.5% move in either direction, okay, between now and the end of the week here, which is basically a little higher than we've seen, which you would expect on a Fed week.
Yeah, I do. And it's great having Heather here. I'll say this. I was very surprised at the volatility over the last 3 weeks in the CME FedWatch tool, which I think got down to one point around 35% chance of a cut in December, which is obviously this week. I think it's now a foregone conclusion, but the volatility in between has been remarkable. And I think the market's sort of been trading on the back of that. When we were down to 35%, that's when the market started to feel a little bit soft. Obviously, we've recovered. This is what I think is going to happen, though. I think it's, again, to use the term, a foregone conclusion that a cut will happen. But I think it's going to be all about the commentary. And what I'll say in addition to that, we're getting pretty close to Jerome Powell's exit day, believe it or not. I think that's going to be in May of 2026. And that's going to be here faster than the market realizes. And what I've said and what I believe, the market's going to test this new Fed chair, whoever he or she is. And when I say test, it means test in terms of yields going higher. So for a lot of different reasons, Dan, I still think 10-year yields are going north of where we're currently trading.
Yeah. So Heather, Guy starts with the equity vol, and we know that when the S&P was in the throes of that, 5% or so peak to trough decline a couple of weeks ago, we had a VIX that was above 25. it's just been melting. And I know that you know as well as anyone else that you could say, oh, that looks cheap to start buying options, whether it's calls, whether it's puts. But look at that chart right there. This thing can, bang around in the mid-teens and you could get chopped up buying premiums. So are you more focused on equity vol into this meeting and on the way out, or are you more interested in maybe what's going on in the bond market?
So I'd say a little bit of both, actually. I think you got to take into consideration both factors of that in order to figure out kind of what's going for it, and to make an educated decision on what what am I going to be playing based on that information. For me, the bond market always tells a story ahead of time, anyways. So everything is typically embedded already inside of there. So I'd say that I'd look at that first and foremost. Then I'd flip over to what's going on in the equity market. But honestly, even with TLT, I don't see a ton of premium that's sitting out there that I could be taking advantage of. So I think for myself, if I was looking at something, maybe I would do a calendar spread if I'm thinking like futuristic, expectations or even movements for next year. I think there's a lot on the table that we can play with, but it's more forward looking, I think, than some things that we're seeing over the next week or so.
So, Guy, when you look at the 10-year, and this is something that you've been pretty focused on, no matter what the Fed does near term, you think the 10-year is going to rise. Let's just kind of pull up a chart of that. We can see from the May highs, we've had this very well-defined downtrend, right? A series of lower highs, lower lows. We're banging up against that uptrend right now. You see that 200-day moving average at 4.25. So what is the scenario you think that the commentary out of Fed Chair Powell, I mean, like to your point, he only has 3 more meetings. We're probably going to get an announcement of his replacement. What do you think the commentary could be that basically, causes a move back towards that 200-day and possibly towards those highs from the summer at about 4.45?
Inflation is more problematic than we thought. It's obviously still something we're concerned about. The labor market weakness is obviously something we're monitoring as well. But I don't think they're going to pivot to inflation being more important than jobs. But I think it's going to come up because, quite frankly, it is. And you're seeing it across a swath of things. I mean, copper, I would submit, is maybe the most important commodity not called crude oil in the world. And that, as we're sitting here, is making all-time highs. So you have a lot of inflationary pressure. So I think that will come up. And you look at this chart. Yes, we're in this downtrend. You're right to point it out. You have a 200-day moving average. It's clearly sloping lower. That comes in around 4.25%. I do think at some point we get there. Then the question is what happens if and when? And I continue, Dan, to point to what's going on in Japan as a possible catalyst for a negative driver for the TLT. TLT lower, bonds higher. And I'm still of the belief that at some point, probably not this year because the year is closing out very quickly, but early next year, we're going to see a TLT either side of 81.
Yeah, and Heather, to your point about you don't see too much premium in the TLT, let's pull up a 1 year. And if I'm looking at implied volatility, the price of options, I have a short dated at about 11%, right? And so if you were an equity person and you were to look at that 11%, you'd say that's dirt cheap, right? Well, this thing generally doesn't move, a whole heck of a lot. But when you look at that chart, you see the flip side of what we were just talking about with the 10-year. And we know that this is the 20-year, but they kind of line up and pretty decently for our purposes. Okay. So now it's sitting on that 200-day. That is support. You also see that gap going back to early September. So if you were of the mindset as Guy is that rates are going higher, right? TLT going lower, and your target might be a gap fill in the near term. What do you do as far as a calendar is concerned? What are you targeting where you think, you get some support in the TLT and you're setting up for a longer dated move for yields higher?
Yeah, so I would say that you can certainly take a look at more going, a calendar spread. I would say that'd be something that you could take a look at maybe going into next year. But that's pretty much where I
Yeah.
could be looking at, yeah.
And just to be clear, what I might consider here is selling a shorter dated, 87 or so put, and then buying a longer dated, maybe something like January or February that's going to cover the next Fed meeting. So, Guy, again, I think these are levels that probably line up with you. The likelihood that we have a move straight to the mid 80s is not great in the near term.
No, I don't. No, in near term, no, I don't think so. But the grind will continue. And you mentioned that gap we have in the chart back from September. Here's a little bit of a different chart than the yield chart. I mean, this is a flattening out of the 200-day moving average. We'll see if we break it, if we start to slope lower, and we'll see subsequently what happens. But, there are a lot of fundamental reasons. The technical reasons are clearly there. The fundamental reasons are there as well. And as much as people want yields to go lower, and as much as they think the Fed controls the bond market, they really don't. And I do think you're going to hear more and more people start to talk about this new Fed chair being challenged by the market. And if you really look at things, it sets up well to be able to challenge him and her. Again, what's continuing going on with Japan, what's going on with global yields in general, and that's obviously our debt problem, which is not going away anytime soon.
Yeah. And so before we started recording here, Heather said, I think Adobe's earnings are going to be more fun than that of the TLT. And I think that's certainly going to be the case here. So they report, Wednesday after the close, like we said before. This is really the last major S&P 500 component that's going to report during this reporting season. And, we had Salesforce this week, and, expectations were really low. And, the company actually beat the quarter. It wasn't a huge beat. It was on earnings, but not on sales. And there was a couple metrics that maybe were a little softer than folks would have expected. And the guidance was okay, but it got the stock going higher, which obviously has a lot of folks looking at this Adobe. So Heather, when you see a chart like this, and maybe Amanda can pull up a 5-year also, I mean, this is one of the worst stories in the entire tech market here. We drew a little support there. You see that this stock, is down from late 21, the all-time highs. That's, way before ChatGPT even came out. So obviously this is a company and their products and services that investors have just made their minds up. They're being disrupted and they don't have a plan for generative AI. How are you thinking first about the technicals? The 5-year obviously looks a little different than that 1 year, but maybe it's setting up for a move one way or another. The implied move is 8.25% in either direction.
I mean, I think you're right. If you take a look at this whole year, they certainly haven't been in the best place, I think. And as we look historically, you can even tell that anytime that Adobe's come out, it's usually based on their guidance, the shift or the movement. So at this point, there's actually a lot of strategies I think that you can employ. And I think you really got to take into consideration, like, what's my end goal? What's my ultimate goal? So am I going to play the shorter term here? So am I thinking more so about the volatility as it relates to what's happening? Or am I thinking more into a long-term perspective? Do I really believe that we're going to see some, a lot of stuff come out of Adobe? Maybe we'll see some additional income that's coming in from AI and from some of the components. But for me, thinking if you're looking at more of a short term, maybe a debit spread. So thinking about that high volatility play, there's certainly some directional upside to a strategy like that, defined risk, especially when you think about that 8% plus move. So I'd say if you're looking at maybe buying an at the money call, right? If we're looking at maybe something that's pretty real close to where we're trading at right now, and then selling a slightly out of the money, using next week's expiration, I think that you're really looking at a better reward to risk scenario. So you're looking probably at about a 2-to-1 for something like that. But again, it goes back to, what am I looking at now? Am I looking at just the short term? I'm going to do a volatility play because there's going to be a crush there in the volatility. Or am I really thinking in the long term that Adobe might do something different? So you see those technicals, it's possible that you could kind of start to see that breakout, but it depends on really what your sentiment's going to be. So I'd say if you're looking for long term, maybe I'd be looking at a diagonal call spread, something to that effect.
Yeah, and I think what you're talking about, maybe Amanda can pull up the implied volatility chart here. I mean, this looks very different than that of the TLT that we just looked at. So to your point about, exploding vol into this event, and I think a lot of it has to do, and Guy's going to give us his fundamental take here, because I think that's really important as being the sentiment so low. But, once this company reports, let's just say it's the sort of report that Salesforce had last week, you're going to see just vol get crushed, right? So if you're owning outright premium, you could get the direction right, you can get the timing right, you can get the magnitude of the move right, but vol's going to come in one way or another, and you could end up not making a whole heck of a lot of money. So I think that's interesting. And then the other one is, like, let's just put up the chart. Guy, you look at that 200-day, and you look at what Salesforce did. It's had a nice 8-9% move since its earnings. Investors, traders, they're going to target these sorts of moves. I mean, and this thing, I wonder, Guy, has the Adobe run ahead of their earnings because it's been up in sympathy with Salesforce?
Yeah, I mean, it has been, but then you look at it and say, okay, it's up from, I think the low we saw was on November 20th. I think we got down about 312 or something. And as we're sitting here, it's either side of sort of 345. So it's had obviously a decent run, but in the context of where it's been, it's really just a blip on the radar screen. And I look at Adobe, it trades at a discount, a pretty significant discount to Salesforce. You saw the reaction of Salesforce on what was a decent quarter, not great, but I think it was a bit of a relief rally. And I think, given the valuation and given some of the pessimism in Adobe around the whole AI strategy, I think anything incrementally positive or even neutral is going to get the stock higher. So I sort of like it right here. Barclays reiterated they're overweight. They reduced the price target, but it's still a $415 price target. And stochastics, the RSIs, are about as pinned to the downside as they've been maybe historically. So I think this sets up for a decent move to the upside.
Yeah. And so, Heather, you were talking about potentially diagonals and you want to take advantage of some of that short dated premium coming out. One trade, and you just mentioned this with the TLT, maybe a calendar. If the implied move, let's say to the upside, gets you to about 370, you see where that 200-day moving average is. I might look to sell the December 370 call at about $6 and use that premium. And I'm going to look out to January 370, and that's about $10, right? So if you think about that, that's not a bad way to take advantage of that kind of setup that you just talked about, especially if you're leaning long the way Guy just kind of articulated the view there, and you think it's going to do what Salesforce is. And then, one interesting scenario is like, how investors early in the year, they're looking for things that didn't participate the year before. They think it might play catch up. So that might be a really good way to finance an out of the money call that could take advantage of a whole host of different things. Does that make some sense to you?
Yeah, it does. I mean, I like that opportunity because I think you still have the ability to play off of that, at that moment in time too. So I still have time between now and January to make a decision or to do something different about my trade. That's part of that managing my option strategy and figuring out, okay, what's next? It's working for me. What's next? Do I want to continue to stay long on it? But I'm with Guy on this. Like if I look a little bit further out, even into next year, if I'm wanting to own this, that longer term strategy might be a better scenario. And I can continue to manage that over the next month and a half, 2 months.
All right, Heather McKnight, we got to do it again after all of these years. Hopefully you'll come back soon. And then in January, it might be interesting to kind of take a look back at the vol in Adobe, the technical setup in Adobe, the fundamental setup in Adobe, and we'll kind of see where this thing is. So again, we really appreciate you being here. Have a great holiday, and we'll see you in January.
You too. Take care. Thanks.
She broke it down. I mean, was a nice interview. I enjoyed that. Hopefully you did as well. I mean, Heather's great. And, when Dan's trading, when I'm trading, we want real-time data, customized alerts, powerful tools that can help us quickly act. Most importantly, we need an easy way to access those insights wherever we are. With the all-new Fidelity Trader platform, Trader Plus platform, you can stay closer to the trade with seamless access to your preferred tools and charts across desktop, web, and mobile. When timing is everything, Dan, and it typically is, you need a platform that can meet you where you are. That's Fidelity Trader Plus.
There you go. Wherever you are, we appreciate Heather being with us. Hopefully we will update some of these ideas that we talked about in January when she's back with us. Guy, let's just hit two names before we get out of here. Oracle, I kind of misspoke when I teed up the Adobe. I said this is the last big earnings. I'd say these next two we're going to talk about Oracle. Yeah. So how are you thinking about Oracle? You and I, back when the stock was like after that big bounce. Yeah. So you see that implied move about 10% in either direction, about $24. You and I wanted to fade it. We thought that there was a really good chance we would fill in that gap. This is back before people were tracking the CDS, because we know that they had to take out a lot of debt to fulfill that OpenAI contract, or at least the build out. It obviously got absolutely destroyed. It's come back a little bit. It's back above that 200 moving average. I mean, this is one of the worst looking charts I've ever seen in my life, guy.
Yeah, no, that's fair. But I'll say this, I think there's a chance that we can, we talked about the potential to fill the gap, and the gap fill was down about 250. Obviously that happened, but it didn't stop, as you just said. I think there's a chance you go back into that prior gap. So somewhere between 250 and 255, which will basically take care of the implied move. That implied move in this case would be to the upside. then I think you fade it again. So if you're asking me, which you are, I actually think there's a chance this thing, you get a move back up to that 255 level and then fade it. So I think you can be long into the earnings release. And it's not to say that all their problems are solved. That's not what I'm saying. There's obviously still a lot of concern on the balance sheet front. That's not going to go anywhere anytime soon, but we're trying to play the trading game here. And I think that trade's going to take place to the upside.
Yeah, there's another way to think of it, though, is that if I'm this company right now and I look at all the trepidation that investors have actually, just kind of brought to the fore here, I might kitchen sink next year. I might just basically bring down expectations. Now, obviously, the stock and the sell-off is suggesting that expectations are pretty low, but you could come out and make the statement that, and by the way, Guy, I don't know if you're following on it. I mean, OpenAI, the press has just turned against this thing. I mean, the articles, like Michael Burry said, he thinks that this is going to be what was the comparison that he just gave? Like I don't know, Global Crossing or World. He gave some example of a name going back to 25 years ago. So this was in one of his posts about the cockroaches. He's obviously very bearish on this, AI build out trade. But I would kitchen sink it. And then the other way to think about it, and I said this the last couple of weeks, I mean, if this stock goes low enough, if you see this stock back towards 150, Guy, I would not be surprised to see the government take a stake in this. And one of the reasons why is Larry Ellison's very close to the administration, very close to the president, and they've taken stakes in other companies. Intel would be another one. So if you think that Oracle is really important for, the build out of OpenAI's technology, and Sam Altman and Masa Son have convinced, the government of that, or the president or the White House, because they have this big Stargate project, and they're going to be building a lot of stuff here in the US. I wouldn't be surprised. Now, I don't think it happens here, but the stock would have to really be creamed. Does that make some sense?
Makes sense. And, if creamed, I mean, I think you're talking to sort of 175 or so. And then I think internally in the administration, they'll say, okay, we have an opportunity. And I think they are playing stock market to a certain extent. We have an opportunity to buy a name everybody knows at a significant discount to the prior high. In this case, it would be a 50% discount if it got to that level. So I think that could happen. I mean, if you're asking me to game it out, I think it rallies post earnings 255. I think it spends a majority of the rest of this year, early next year, sort of sifting back lower. And if it does get low enough, I think the point that you just made about the government stepping in is not that far fetched.
All right, last one. Broadcom made a new all-time high here today, guys. So it's bucking the NVIDIA, which obviously is a competitor here. 7.5% implied move into the report. We got to go back to look at December of last year. If she can, Amanda can bring us out over there. You remember that huge 40%
move?
Look how much higher. I thought that, look at that move after that gap. It looks like Oracle, doesn't it? Like that looks exactly like what Oracle just did. So for folks who think that Oracle is done and dusted, you know what I mean? Like, look at what this thing has done. Now, very different companies, but thoughts into this one. It's really hard. The last quarter, the stock was at all-time highs, had that huge gap, and it's held that gap. But I don't know, man. This one's hard to chase.
I'm not. I don't think you chase. Again, as we get, this is a company that for the longest time was basically just a mirror. The 200-day moving average provided a bit of a trend line and support level. Obviously, in April, May, June, that started to change. And here we are, a couple standard deviations away. So I think if you're long, if you've enjoyed this run higher, good for you. I think you got to move your feet and do something. Listen, could they say something that excites people again? I guess in this environment, anything can happen. But a company that I liked for a long time on valuation, I can no longer like it for those reasons. So, I think you're looking for a pullback. And in this case, I don't think it's unreasonable to see a pullback to 350 or thereabouts.
All right. We covered a lot of ground here. We had Heather Knight on with us. That was fun. Sometimes it's really good to get a look. You and I are doing a lot of fundamentals, a lot of the technicals. We try to hit some of the option stuff, but she is obviously an expert. So it's great to have her on. All right. We're going to be back tomorrow morning. You have a conversation that's going to be dropping. So we're going to check that out. You guys are going to be looking at the Fed. And then we got a bunch of earnings. So we'll be back here 11 a.m. We got the Risk Reversal Pod all week. So check all of that out. Guy Adami. See you later.
See you later, folks. This episode of Market Call is presented by Fidelity Investments and their all-new advanced trading platform, Fidelity Trader Plus. Try it at fidelity.com/Trader Plus. Fidelity Investments and Market Call are not affiliated. Views, opinions, products, services, and strategies discussed are not endorsed or promoted by Fidelity Investments. Fidelity Brokerage Services, LLC, member NYSE, SIPC.